Understanding free cash flow to the firm or free cash flow to equity requires a good understanding of the financial statements. This video will only calculate free cash flow available to the firm using net income. It can also be calculated from the statement of cash flows. Now, what is free cash flow? Free cash flow is the cash available to a company's providers of capital after all expenses, including taxes, have been paid and operating investments have been made. Now, if you look at your computer screen here, you should see over here I've got a basic income statement or rudimentary view of an income statement, which starts with sales or revenue and subtract my first direct expense, which is referred to as the cost of goods sold or manufactured, leaving us this gross profit, and then we subtract our indirect, which are sales, general, administrative expenses, and we get the earnings before I pay my interest and taxes and any depreciation or amortization here. This non-cash cost here, or non-cash expense, is referred to as either depreciation, amortization, or depletion. Then I have my earnings before I pay my interest and taxes. And here's at the very bottom my income statement. Over here is a balance sheet, and there's your assets and the equal liability plus equity. And this is what we're trying to determine here. The cash is available to our suppliers of capital, which are our bond owners or our bond lenders and our stock holders. Now, the first thing I want to go ahead and draw down here is I'm going to do the first part of your free cash flow available to the firm. There's a couple ways. I'm going to do the first way. I like to travel down the income statement until I get the earnings before I pay my interest and taxes, which is right here. There's going to be another way of doing it in just a second. I'm going to show this way first. What I do now is I have to remove my taxes because it is an after tax. Now, why did this way? 1 minus the tax rate. So if the tax rate is 0.4 or 40%, if I subtract 1 from 0.4, I get a 0.6, and if I multiply 0.6 by this, I get what's left of after tax. It's just an easy way of doing it. And now I have to add back any non-cash cost here because we really didn't pay anybody. It just reduced our income level, so we pay less taxes. That's actually the first part of free cash flow. Sometimes they refer to this as operating cash flow. Some books will show it this way. They'll just go to net income. They'll start at the bottom instead of I started here. They'll start down here and just work their way up. And then they go ahead and add their non-cash cost, and then they add the interest, and then they go ahead and 1 minus the tax on the interest. It's just another way of doing it. Again, that's both our operating cash flow, whatever works best for you. One thing I want to point here, one of the best places to find this non-cash charge would be on the statement of cash flows or cash flow from operations. You can find this here, as well as on your income statement. Now let's come over here to the balance sheet. A few things on the balance sheet I want to look at is some long-term assets, and I'm also going to look at short-term assets. So that's long-term. I'll look at current assets. And I'm also going to look at current liabilities here. I'm going to do the second part of it. I'm going to subtract because this is going to reduce the cash as available to suppliers of cash. I'm going to put a bracket here so we keep it all together. Well, a few things that we might reduce our cash flow would be what's called a capital expenditure or fixed cost in investing. If I buy a piece of equipment, I can't use that money to pay my investors. So if I purchased a piece of equipment here, it could be I purchased a trademark. Again, the statement of cash flow is an excellent place to find this. In addition, if I sold a piece of equipment for additional cash, this would actually offset this and make this number a little less. So we're looking for both if we spent or we sold a piece of equipment. And a great place to find this, again, is on the statement of cash flows. Now I have to also add any change in working capital, which would be here. Now, changes in working capital, I'm only going to look at accounts receivable and accounts payable. I leave out cash because what I'm attempting to do with this entire equation is discuss the change in cash. So I don't want to deal with cash and cash equivalents. In addition, I'm going to leave out any short-term notes because, in essence, it's more of a financing thing, and I'm looking at just the change in cash. So what we do is look at accounts and accounts receivable, and if I guess accounts payable increased, accounts receivable decreased. Well, let's basically say there's an increase in the cost of capital, whatever that number is. This working capital we added to this capital, we'll call this investment, and that would also reduce. Now, there are some variations to free cash flow from firm. It's important that whatever method you use, you be consistent. This is the method I use. So one last time, free cash flow from firm is I start with earnings before interest and taxes. I reduce my 1 minus taxes, because it's after-tax costs. I add back any non-cash expense. That would be the operating cash flow. There's a second approach. And then I subtract any change in, let's say, we'll call this a capital expenditure if I purchased a piece of equipment. And here would be an increase or a change in net operating working capital. And again, I'm only looking at accounts receivable and accounts payable to use, looking for an increase here. And an increase would be added back because that's cash that's not available to my investors.